You're welcome to this channel. We want to look at the conceptual framework of the International Financial Reporting Standard. The conceptual framework is like the bedrock or foundation of IFRS. In fact, before any IFRS is published, in the course of developing the IFRS, the developers must first consult the conceptual framework to ensure that everything that they are going to write, in the new standard is in line with the conceptual framework. So if you are going to be a student of IFRS, you must first study the conceptual framework. All right, so let's start by looking at the objective, usefulness, and limitations of general purpose financial reporting. The objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. So every business has stakeholders, okay? So you have the shareholders. They want to know, have information about their dividends that will be paid to them at the end of the year. We have the creditors, they want assurance that the company is making money so that they can have guarantee that their money is going to come back. Okay, you have the employees that also need to be assured that the company is liquid so that their salaries, and promotions are guaranteed, and so on. So you have lenders that want to have confidence, like banks, they want to have confidence that this company or this business is credit worthy before they give out loans. So basically, stakeholders need financial reports to make decisions. So these decisions involve decisions about buying, selling, or holding equity and debt instruments. Right? Before I buy shares in a company, I want to have information about how well that company is doing. I want to know whether I should sell my shares, all right, in that business or not. Okay, that is if I'm holding their shares already. Okay, providing or selling loans and other forms of credit, or exercising rights to vote on, or otherwise influence management actions that affect the use of the entity's economic resources. So basically what we are saying is that stakeholders, they need financial reports to be able to make decisions. Now, these financial reports have their limitations. For example, they cannot provide all of the information that existing and potential investors, lenders, and other creditors need. Okay, so we need to realize that, and that is why we need other reports. Okay, for example, now a financial report will not tell you, will not give you information about non-financial issues going on in the organization, okay, which will have serious consequence for the organization. All right. Culture, for example, you want to buy an organization, you want to buy a business, all right, but the cultural issues in that organizations cannot favor the acquirer. You will see that in the financial statement. Okay, I think it was it Microsoft or so that bought a company some time ago in Asia, and they had to let let the company go for a fraction of what they bought it because of cultural issues. You will not see that. Okay, you will not see that if you are looking at the financial statements, for example. Okay, general purpose financial reports cannot show you the value of a reporting entity. Okay, Elon Musk just bought Twitter. Okay, but the value of Twitter will not be in the financial statements. Okay, there will be indicators, of course. You will get indicators of the value of the business from the financial statement, but you cannot get the exact valuation of the business from the financial statements. Okay, so let's talk about qualitative characteristics of financial information, which is very, very important. For some of us that will be writing IFRS examinations, we are expected to know these two qualitative characteristics of useful financial information. All right, so we are talking about fundamental qualitative characteristics, and we are talking about enhancing qualitative characteristics, the two of them. Now, the fundamental qualitative characteristics are relevance and faithful representation. So what do you mean by relevance? All right? Relevant information should be able to affect the decisions of the users of the financial statements. Okay? And for a financial information to affect the decisions of the users, it means it must have predictive value and it must have confirmatory value. Either of those values or the two of them, both of them together. So when I look at the financial information, I should be able to predict whether that organization, right, will continue into the foreseeable future, going concern assumption. All right, so if you see a financial statement, all right, being published on breakup basis, that is telling you that in the next 1 year, that company is not going to be existing again. You just know, all right, predictive value. Okay, you should be able to look at financial statements over like 3, 4, 5 years, and you're able to predict whether they are going to declare dividend in the next financial year or not. Predictive value. Confirmatory value. You may have had some assumptions about a business, about an organization, right? And when you look at the financial statement, you are able to confirm the assumption. So, Otumba so and so has been appointed as the CEO of so company in the beginning of the financial year, and you are very much familiar with the antecedents of that new CEO. So you know that this guy is going to turn around this company. I'm very sure of that because of the history of performance. Then at the end of the financial year, you can hold the financial statement and say, yes, I said so. Okay, I said so. You see, that's why I bought the shares of the company when this new CEO took over, because I know there will be capital appreciation. Then you confirm with the financial statement, looking at the performance of the organization. So maybe their profits actually doubled, right, or even tripled. Okay, when you look at the published financial statement, confirmatory value. So a good financial information should either have predictive value or confirmatory value, or both. Then a good financial information should be faithfully represented. Okay, so faithful representation. Okay, so to be useful, financial information must not only represent relevant phenomena, but it must also faithfully represent the substance of the phenomena that it purports to represent. So it means the information should be complete, should be neutral, and should be free from error. Faithful representation, document it as it happened. Okay, for the accounting students, you know, and accounting and auditing students, you know about, you know, what we call the assertions, right? Assertions of existence. Assets, do they actually exist? Assertions of occurrence. Do the transactions actually occur? All right, assertions of ownership. Okay, does the company or the business actually owns the assets? Assertions of rights and obligations. Okay, rights to assets, obligations as regard the liability. Faithful representation. So if you look at the financial statement, trace it to the ledger, trace it to the source document, trace it to physical assets of the organization, trace it to the inventory. We should be able to confirm that yes, everything agrees. Okay, that's faithful representation. Okay, complete information, neutral, all right, without bias, then it is free from error. So that is what we mean by fundamental cognitive characteristics. All right, the information should be relevant and should be faithfully represented. Okay, then we have enhancing qualitative characteristics. So for that, we have comparability, verifiability, timeliness, and understandability. Comparability, we should be able to compare a financial information with another financial information so that we can do variance analysis. That's why you see in IFRS, right, there's no financial reports you will see that you will not be able to compare with the previous year. Okay, so if you are looking at the income statement, you are looking at the income statement for this year versus what happened last year. We want to be able to see the trends, okay, in the business entity as regards financial performance. In fact, in the old GAAP, Nigerian GAAP, we used to have a financial statement over the period of 5 years. Okay, even though IFRS does not really does not allow for that, but at least IFRS 2 years. So you should be able to compare financial information over a period. Okay, verifiability. So we should be able to, any information you put in your books, we should be able to verify it. Okay, so we should be able to have evidence, okay, for auditors or for any stakeholders to be able to support the financial information. Okay, so every information in the financial statement should be verifiable. Then timeliness. Okay, so we should be able to have financial information on time. So this is, for example, this is 2022, and then you have maybe you have some organizations, financial report, financial statement of 2019 is not yet ready. You know, so I do people that want to make decisions, people that want to buy shares, that want to dump the shares, people that want to maybe give credits or record their credit. How do they make decisions? So information should be available on time. Should be available on time. The understandability. All right. So that financial information should be understandable. We are not saying you should you should break down accounting information or financial information for somebody in the markets. All right. For it's not accounting information, financial information is technical. So we need to understand that. So anybody looking at the financial statement should have had a level of financial intelligence. Okay, but what we're saying here is that the financial statement you are preparing should be understandable for somebody with at least an average knowledge of accounting. That's why you see when you get to IS1, IFRS does not encourage set off. Okay, so you are owing the company is owing you. Okay, then you set up the amounts. Then you have a net, trade payable. It's not allowed because we will not understand. We don't know where they are coming from. Okay, so if you are owing a third party, show us clearly what you are owing the third party. If the same third party is owing you, show it clearly that they are owing you in different sections of the financial statements. Rather than you for you to set it up, then you confuse everybody. Then anybody that is not really party to the transactions between the two of you can't understand what you are doing, what you have just documented or published in the financial statement. That's part of what we're saying. So avoid scenarios where you are going to confuse, right, the users of the financial statement. So those are the 4 enhancing qualitative characteristics. Should be able to compare financial information over a period. Okay, we should be able to verify financial information. We should be able to get financial information on time. you should be able to understand financial information. Okay, so don't forget the fundamental and the enhancing qualitative characteristics of information. Okay, so let's look at financial statements and the reporting entity. So basically, like we said, financial information is provided in the statement of financial position by recognizing assets, liability, and equity. So for a reporting entity, we should be able to see the position of assets, the value of assets in the organization, value of liability, right? The carrying amount of equity. Okay, and those, like we shared in the accounting equation, those three components of the statement of financial position, you see them in that financial part of the financial statement formally covered sheet. Okay, B, in the statement of financial performance by recognizing income and expenses. So we want to know the income generated over the accounting period, expenses incurred, matching concepts, right? Then we have the net profit. Then, of course, in other statements and notes, by presenting and disclosing information about recognized assets, liabilities, equity, income, and expenses, including information about their nature and about the risks arising from those recognized assets and liabilities. Assets and liabilities that have not been recognized, including information about their nature and about the risks arising from them. So we have information about assets, liabilities that have not been recognized, including information about their nature and about the risks arising from them. Okay, so we'll be looking at IAS 37 for that. Cash flows, okay. Contributions from holders of equity claims and distributions to them. The methods, assumptions, and judgments used in eliminating the amounts presented or disclosed, and changes in those methods, assumptions, and judgments. So basically, we are providing information for the users of the financial statements. Okay. Reporting period. Of course, the reporting period is a period that is covered by the accounting information. Most of the time is usually 1 year. Of course, some organizations we choose to do quarterly reports or semi-annual reports, but basically, most of the time we have the reporting period covering 1 year. Okay. So so the financial statement provides information about assets and liabilities, like we said, income and expenses for the reporting period, and so on. Then we have the going concern assumption. So going concern assumption is relevant for financial reporting. If you are publishing a financial statement, you are publishing it with the assumption that that organization will continue into the foreseeable future. That's what the going concern assumption is all about. So every business that you are publishing their financial statement, okay, you are publishing with the intent to inform us with the assumptions that that organization will continue into the foreseeable future. So if it is not going to, maybe you are already sure that the information, the company cannot exist for more than 1 year. Okay, after the publication of the financial statement, then the financial statement should be prepared on what we call break-up basis. So we are ready to go. So the reporting entity is the entity that is preparing the financial statements for its stakeholders. They're very important. We want to look at the elements of financial statement. Very, very important. The definitions by the Conceptual Framework. Okay, so we have assets, liabilities, and equity, which relate to the reporting entity's financial position. So formerly known as balance sheet, statement of financial position. You see those three components there. Income and expenses, which relate to the reported entity's financial performance. Then we need to look at the definition. What's an asset? Okay, according to the conceptual framework, an asset is a present economic resource controlled by the entity as a result of past events. Simple definitions, definition, but very, very loaded. All right. So an economic resource is a right that has the potential to produce economic benefits. Initially, in the earlier version of the conceptual framework, they were looking at it in form of the economic benefits, the economic resource in terms of cash flow. All right, an asset is, is an entity that can give the organization, future cash flow. All right, but they've realized that it's not all assets that you can actually be able to show that, okay, this is the naira equivalent of what this asset will give. So instead of just calling this, limiting to cash flow, naira and kobo, let's look at economic benefits. Okay, so a present economic resource. So you have that resource now in the organization, controlled by the entity, and that control means you have a right to it. Okay, maybe by virtue of your paid or you have transfer value for that particular asset. So controlled by the entity as a result of past events, and that past event is that you have transfer value for in exchange for that asset. Okay, then liability. Liability is a present obligation of the entity to transfer an economic resource as a result of past events. So something has happened in the past, you have borrowed money, or you have bought an asset, or somebody has ordered for goods which you have not yet delivered, but you have the money. The money is not an income, it's not a revenue yet, right? It is in your hand, all right, but it is hot cash which can burn the finger. So you have to recognize it as a liability, right? Past events, a present obligation, all right, as to transfer an economic resource. So you've collected goods on credits, that creates an obligation. You have collected loan, that creates an obligation to transfer economic resource, which could be financial or otherwise. That's why they are very careful in the choice of words, in choosing that word, those words, economic resource. Okay, because it might mean you are transferring fiscal, financial value, or even an asset. Okay, equity, the residual interest in the asset of the entity after deducting all its liabilities. This definition is from the accounting equation. Remember the accounting equation, we say the assets is equal to capital plus liability, right? Capital, resource produced by the owners of the business, plus resource produced by external third parties. So from the accounting equation, that means capital. So that means capital itself. We said assets is equal to capital plus liability. So that means capital is equal to assets minus liability. Okay. So equity is the residual interest in the asset of the entity after deducting all its liability. Okay, so that definition is drawn from the accounting equation. Income. Income is the increase in assets or decrease in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. That's a very technical definition. Increase in our assets or decrease in our liabilities that result in increase in equity other than those relating to contributions from holders of equity claims. So an income is, an inflow basically to the organization. Okay, so you can increase, somebody paid for an asset, a good, an inventory in cash. Okay, and that cash, that cash, of course, is current asset. So income now is an increase in cash or increase in bank accounts. Or they said, okay, we are not going to pay in cash. You are owing us. You are owing us 500,000. So instead of you paying us the value of the good 200,000, reduce, debit that liability account. So reduce your liability, your liability account with 200,000. Let it drop from 500 to 200. For 500 to 300. So that one, you are not receiving cash. Your asset is not increasing, but that income is decreasing your liabilities. Okay, so that is what we mean by income. Then you have expenses. Expenses is decrease in assets or increase in liabilities that results in decreases in equity, other than those relating to distributions to holders of equity claims. So you bought something. How are you going to pay? You're going to pay in cash or through bank. Okay? And if you pay through cash, that means you have reduced your cash balance. If you pay through bank, you have reduced your bank balance. Those are assets, right? And if you bought on credits, okay, if you bought on credits, then that means you are increasing what? Your current liability. So that's why they say it is either decrease in asset or increase in liability. So it's good as an accountant or a student of IFRS that you understand these definitions. Very important. Now let's talk about recognition and derecognition. What's recognition? Recognition is the process of capturing for inclusion in the statement of financial position or in the statement of financial performance an item that meets the definition of one of the elements of financial statements. So it's either an asset, you capture an asset, or you capture a liability, or you capture equity, or you capture income, or you capture an expense. So if it does not meet that definition, the definition we have explained here, then you cannot recognize it in the books. Okay? And of course, the recognition is the opposite of recognition. So the recognition is the removal of all or parts of a recognized assets or liability from an entity statement of financial position. Okay, the recognition normally occurs when that item no longer meets the definition of an asset or a liability. So for example, for an asset, the recognition normally occurs when the entity loses control of all or part of the recognized asset. So you have a motor vehicle in your asset accounts, and somehow maybe the motor vehicle was taken away in exchange for maybe a credit. So we said that you can outflow of resources. Those one, we talk about outflow of economic resource. So you use the vehicle to settle a loan, for example, or to settle for goods. Okay, so you have to de-recognize the value, the carrying amount, or the carrying value of that particular vehicle from your books. Okay, so once you have lost control of the assets, you have to recognize it. Or you have a building in your non-current assets, and something happened, maybe an act of God, that was a tsunami or flood, whatever, and the building collapsed. Okay, so you have to, the building is no longer there, so you have to recognize it. So the asset is no longer under the control of the entity. So for a liability, the recognition normally occurs when the entity no longer has a present obligation. So a company, you are owing a company maybe 500,000, or you took a loan from the bank. 500,000. Okay, and you paid off. So you cannot continue to keep that on your books, you have to recognize it. So the recognition simply means you remove all the parts of a recognized item from the books of the organization. So, ladies and gentlemen, this is the end of the presentation. We have laid the foundation for IFRS by looking at the conceptual framework. Thank you. If you have questions, you can post your questions in the comment section. I will definitely attend to them. Thank you.